Something changed in Bitcoin this week, not because a headline said so, because the selling stopped being voluntary. When markets move like this, the instinct is to ask one question: is this the bottom? But in our strategy, that is never the right place to start. The right starting point is structure, who is selling, and whether they actually had a choice. This recent move was not driven by new information, it was driven by leverage being forced out. That distinction matters more than price levels. Forced selling compresses time. Moves that usually take months happen in days. That is how markets overshoot. Bitcoin pushed to one of its most extreme distances from trend in its history, not as a signal to predict upside, but as evidence of mechanical stress. When positioning resets this violently, the probability of mean reversion rises. That does not mean resolution, it means pressure release. This is where many investors get trapped. They confuse a relief rally with a new cycle. Our strategy keeps those two ideas separate. From a phase perspective, this still fits a late phase 2 environment. Volatility increases, liquidity stabilizes, but does not yet accelerate. That combination historically supports counter-trend rallies, not sustained upside, and not immediate collapse either. If you find it difficult to tell the difference between noise and structure in moments like this, that is exactly the skill we focus on here. Following along helps you build a framework that filters emotion out of fast markets. Before we go further, a quick reminder. This is educational commentary, not financial advice. We are discussing probabilities and process, not actions. Back to the setup. Volume expanded during the sell-off, not during the bounce. That usually signals ownership transfer, not trend confirmation. The dollar remains the key constraint. If dollar strength resumes aggressively, rallies fail. If it stabilizes, relief has room. This is why confirmation matters more than anticipation. We do not need to act early. We need to avoid acting wrong. One thing that helps investors most in environments like this is staying connected to the full sequence, not just the moment. If you want clearer context around phases, signals, and what actually changes as markets evolve, subscribing keeps that perspective continuous instead of reactive. What changed this week is short-term pressure. What did not change is the broader cycle risk still sitting ahead. A bounce can be strong and still be corrective. That is not bullish or bearish. It is structural. So the takeaway is simple. This move reduced downside urgency. It did not resolve the cycle. We stay patient, we stay conditional, and we let signals confirm before narratives take over. We do not need to be early, we just cannot afford to be late.